Hi everyone, it's that time of year again, tax time. So I'm going to do 3 videos on investment and tax planning strategies that you can use during your wealth accumulation phase, your wealth achievement phase, or your wealth distribution phase. Today we're going to discuss the wealth accumulation phase, that time of your life where you're working and still able to save money. Knowing how to minimize taxes over your lifetime will be able to put a lot more money in your pocket. Making the right decisions can be the difference on saving tens and sometimes hundreds of thousands of dollars over your lifetime. So we're going to discuss 3 strategies. First, maximizing savings in your 401k using either a traditional or a Roth 401k. Let me explain the differences first. So in a traditional 401k plan, you're putting money away pre-tax money. The government's actually giving you some money, so you have a little bit more money to save and invest in your 401k, which will grow tax deferred over your lifetime. But then in retirement, you have to pull that money out. When you pull that money out, you have to pay taxes on that. In a Roth 401k plan, you've already paid taxes on that money, so you have a little bit less money to invest. That money will still grow tax deferred for you, but in retirement, when you use that money, you now get to take it out and you don't have to pay taxes on it. So which is the right strategy for you? Well, the rule of thumb is if you're in a high tax bracket now and a lower tax bracket later, you should use a traditional 401k plan. Conversely, if you're going to be in a low tax bracket now and a high tax bracket later, then you're better using a Roth 401k plan. If you don't know what tax bracket you're going to be on, you can even split the 401k and do some in a traditional and some in a Roth. And I know some plans, some companies may not even offer a Roth 401k plan. If your company does not, talk to them. It's an easy fix to add a Roth as an option in your 401k plan. For 2021, the max amount you're able to put away is $19,500. And if you're over 50, you can put away another $6,500. Strategy number 2. So let's say you're already maxing out your 401k plan. You want to save some more money in retirement. So strategy number 2 is a non-deductible IRA. I do want to point out though, there are some people that may qualify for a regular traditional IRA or a Roth IRA, depending upon their income limits, even though they have a 401k plan. But for this strategy, let's assume that you make too much money and you're not eligible for that. So you can still do what's called a non-deductible IRA. You can put away $6,000 if you're married, $7,000 into an IRA. It's non-deductible, so you don't get a tax deduction. The money does grow for you tax deferred, and it'll accumulate over your lifetime. When you pull money out of it in retirement, you only have to pay taxes on the earnings that you made, not on the amount that you contributed to it. I do want to caution, you do want to file Form 8606 to make sure that you don't pay taxes twice on the amount that you contribute to a non-deductible IRA. Strategy number 3 is taking that non-deductible IRA and going one step further, and now converting your non-deductible over into a backdoor Roth. Now, the strategy is legal, but I do want to emphasize it doesn't make sense if you currently have, or for most people, it doesn't make sense if you currently have an IRA. If you don't have an IRA and your 401k is your only retirement savings, then doing a backdoor Roth is a great idea. So now you've contributed the same $6,000 or $7,000 to your non-deductible IRA, and now you go one step further and you convert that to a backdoor Roth IRA. This is perfectly legal, although some advisors do suggest that you do have some time between converting after contributing to a non-deductible IRA. Now, what is the difference here? Well, in a Roth now, that money not only gets to grow tax deferred, but when you go to withdraw the money later on, you don't have to pay any taxes on that. So if you're married and you're 50 years old, as a couple, you're going to put away $14,000. From 50 to 70, it's 20 years of putting away $14,000, growing tax deferred, and then pulling that money out tax-free in retirement. This is a nice pot of money on top of your 401k plan. So let's summarize the three strategies. Strategy number one, traditional or Roth 401k, maximize the amount you can put away. Strategy number two, a non-deductible IRA. And strategy number three, a backdoor Roth IRA. I do want to recommend that you discuss all these strategies with a professional because everyone has a different situation. I'm Larry Heller from Heller Wealth Management. Thank you for joining me today, and stay tuned for my second and third videos on wealth distribution and wealth achievement phases.